It happened. After years of regulatory warfare, after billions lost to enforcement actions, after countless predictions that the government would crush this asset into oblivion, the United States of America just legalized the Bitcoin revolution. Not with a quiet memo, not with an obscure regulatory clarification, with a law signed by the president, published in the Federal Register, effective immediately. And within 72 hours of that signature, Bitcoin exploded past $95,000. Right now, as you watch this video, the largest transfer of institutional capital in cryptocurrency history is underway. Pension funds that were legally prohibited from touching Bitcoin are now authorized to allocate. Banks that faced regulatory threats for offering crypto custody are now protected by federal statute. The trillions of dollars that have been sitting on the sidelines, waiting for regulatory clarity, are flooding into the market. And they're all racing toward the same door. $100,000 is not a question anymore. It's a countdown. The mainstream financial media is scrambling to explain what happened. They're calling it a surprise rally. They're attributing it to market sentiment. They're doing everything possible to avoid telling you the truth. The truth is that the United States government just fired the starting gun on the greatest asset repricing in financial history. The law that was signed this week doesn't just clarify Bitcoin's status, it creates a legal framework that transforms Bitcoin from a speculative asset into a recognized component of the American financial system. It grants the same protections to Bitcoin holders that have historically been reserved for stocks, bonds, and real estate. This changes everything. Not gradually, not over years. Now, the $95,000 price you see on your screen is not the destination. It's the departure point. The smart money that has been accumulating for years understood that regulatory clarity was the final catalyst. Now that catalyst has arrived. And they're not selling, they're buying more. Welcome to Chronicles of Currency. The law has been signed. The 100K breakout is imminent. Let me show you exactly what happened and why the next 30 days will create more millionaires than the last 30 years. I'm your host, and this is the channel where we decode the monetary signals that reshape the global financial system. We don't chase hype. We trace the structural forces that move markets. And what I am about to show you is the most significant structural shift in Bitcoin's 15-year history. On Tuesday of this week, the president signed into law the Digital Asset Market Structure Act, known colloquially as the Bitcoin Clarity Act. It grants the same protections to Bitcoin holders that have historically been reserved for stocks, bonds, and real estate. The bill is 847 pages long. I've read every single page. What I found is not just bullish for Bitcoin, it is transformative. This law does three things that the crypto community has been demanding for over a decade. First, it establishes clear jurisdiction, ending the SEC versus CFTC turf war that has created regulatory chaos. Second, it creates a pathway for banks to custody and offer Bitcoin products without fear of enforcement action. Third, and most explosively, it authorizes state pension funds to allocate up to 3% of their portfolios to Bitcoin and other approved digital assets. That third provision alone unlocks over $600 billion in potential institutional buying. The market understood this immediately. Within hours of the signing ceremony, Bitcoin broke through $90,000 resistance. By Thursday morning, it touched $95,400 before consolidating at current levels. This is not speculation driving the price. This is law, federal law that cannot be reversed without another act of Congress. The regulatory uncertainty that has suppressed Bitcoin for years has been eliminated, and the capital that was waiting for this moment is now in motion. Let me walk you through exactly what this law contains. Let me break down the Digital Asset Market Structure Act section by section. Because when you understand what this law actually does, you will understand why $100,000 is not just possible, but inevitable. Section 1, Jurisdictional Clarity. For years, Bitcoin has existed in regulatory limbo. The SEC claimed it was a security. The CFTC claimed it was a commodity. Banks were afraid to touch it because they didn't know which regulator would come after them. This law ends that ambiguity permanently. Bitcoin is now legally classified as a digital commodity under the exclusive jurisdiction of the Commodity Futures Trading Commission. The SEC has no authority over Bitcoin. Full stop. This means that every pending SEC enforcement action against Bitcoin-related businesses must be dismissed. This means that every bank that was warned against offering Bitcoin services can now proceed without fear. This means that the regulatory weapon that has been used to suppress adoption has been dismantled. Section 2, Banking Authorization. This is the section that the mainstream media doesn't want you to understand. The law amends the Bank Holding Company Act to explicitly permit national banks, state-chartered banks, and credit unions to provide custody, trading, and lending services for Bitcoin and other approved digital assets. Previously, banks faced enormous regulatory risk for offering crypto services. The Office of the Comptroller of the Currency issued conflicting guidance. State regulators added their own requirements. Banks that tried to enter the space faced coordinated pressure from multiple agencies. That pressure is now illegal. The law explicitly prohibits federal regulators from discouraging banks from serving lawful digital asset businesses. The practice known as Operation Choke Point 2.0 is now a federal crime. This opens the floodgates for banking adoption. JP Morgan, Bank of America, Wells Fargo, every major bank can now offer Bitcoin services with full legal protection. Their compliance departments, which have been blocking crypto initiatives for years, no longer have a regulatory excuse. Section 3, Pension Fund Authorization. This is the atomic bomb of the legislation. The law amends the Employee Retirement Income Security Act, ERISA, to explicitly permit pension fund managers to allocate up to 3% of assets under management to Bitcoin and approved digital assets without breaching their fiduciary duty. Let me translate what this means in dollar terms. U.S. pension funds manage approximately $35 trillion in assets. A 3% allocation limit means up to $1.05 trillion in potential Bitcoin buying. $1 trillion. The entire current market cap of Bitcoin is approximately $1.9 trillion. We are talking about potential institutional buying equivalent to 55% of the total existing market cap. Even if only 10% of pension funds allocate the maximum, that's $105 billion in new buying. That is more than double the total inflows that drove Bitcoin from $15,000 to $69,000 in the 2021 cycle. Section 4, Tax Simplification. The law creates a new tax framework for digital assets that eliminates the most punitive aspects of current treatment. Capital gains on Bitcoin held longer than 3 years are now taxed at a reduced rate of 15% maximum, regardless of income level. This encourages long-term holding rather than speculation. Mining income is no longer taxed until the Bitcoin is sold, eliminating the cash flow burden that has crushed small miners. Like-kind exchanges between approved digital assets are now permitted, allowing portfolio rebalancing without triggering taxable events. These provisions will bring billions of dollars off the sidelines from investors who have been afraid of the tax complexity. Section 5, Strategic Reserve Study. The final section mandates a Treasury Department study on the feasibility of including Bitcoin in the Strategic Reserve of the United States. The study must be completed within 180 days and submitted to Congress. This is not a commitment to buy Bitcoin for the national reserves, but it is official acknowledgement that Bitcoin is being considered as a strategic asset alongside gold, oil, and foreign currencies. 6 months from now, we may see the U.S. government recommending Bitcoin purchases for the National Reserve. The implications are staggering, 5 sections, each one individually bullish. Together, they represent the most comprehensive pro-Bitcoin legislation in the history of any major economy, and it is now the law of the land. Let me explain why this law changes the fundamental equation for Bitcoin in a way that makes $100,000 not just possible, but mathematically inevitable. Before this law, Bitcoin had 3 structural barriers to mass institutional adoption. Barrier 1, regulatory risk. Institutions operate under strict compliance frameworks. Their lawyers, compliance officers, and boards of directors need to approve every investment. When regulators are hostile and jurisdiction is unclear, these gatekeepers say no. It doesn't matter how bullish the investment thesis is. If the compliance department believes there's enforcement risk, the trade doesn't happen. This law removes that barrier completely. Bitcoin is now a commodity with clear federal oversight. Banks are explicitly authorized to provide services. Pension funds are explicitly authorized to invest. The compliance department no longer has a valid reason to say no. Barrier 2, custody risk. Large institutions cannot hold assets without qualified custodians. Insurance companies won't write policies without regulatory clarity. The infrastructure for institutional Bitcoin custody has existed for years, but the regulatory uncertainty made it unusable for most institutions. This law authorizes banks to provide custody. Banks are the most trusted custodians in the financial system. When JP Morgan offers Bitcoin custody, pension funds that would never use Coinbase will allocate billions. The custody barrier is eliminated. Barrier 3, fiduciary risk. This was the final and most powerful barrier. Pension fund managers have a fiduciary duty to act in the best interest of their beneficiaries. Historically, investing in an asset with unclear regulatory status could be considered a breach of that duty. Fund managers could be personally liable. No fund manager would risk their career and personal assets to buy Bitcoin, no matter how compelling the investment case. This law explicitly protects them. By stating that allocations up to 3% do not breach fiduciary duty, Congress has given pension managers legal cover to invest. They can now allocate to Bitcoin without personal liability. They can defend the decision to their boards, to their auditors, and to the courts if necessary. All 3 barriers have been removed simultaneously. This is not incremental progress. This is a phase transition. Imagine water at 99 degrees Celsius. It's hot, but it's still liquid. Then you add one more degree and suddenly everything changes. The water becomes steam. The physical properties transform completely. That's what just happened to Bitcoin. The law was the one additional degree that transformed the physical properties of the market. The same Bitcoin that institutions couldn't buy yesterday, they can now buy freely today. The same asset that compliance departments rejected is now approved. The same investment that fiduciary standards prohibited is now permitted. Nothing has changed about Bitcoin itself. Everything has changed about who can buy it. And who can buy it now includes entities with $35 trillion in assets under management who have never been able to participate before. This is why $95,000 is not the destination. The market is just beginning to price in the new reality. The institutions are just starting to move their internal approval processes. The pension funds are just beginning to draft their allocation memos. The buying that drove Bitcoin to $95,000 was anticipation. The buying that will drive Bitcoin past $100,000 is implementation. And that implementation is just beginning. Let me show you the evidence that institutional buying is already accelerating in response to this law. Evidence 1, ETF inflows. In the 3 trading days since the law was signed, spot Bitcoin ETFs have recorded $4.2 billion in net inflows. This is the highest 3-day total since the ETFs launched in January. To put this in perspective, the ETFs averaged $200 million per day in the previous month. We are now seeing $1.4 billion per day. That is a 7x acceleration. The institutional money is arriving. Evidence. 2. Coinbase institutional volume. Coinbase, which operates the largest institutional trading desk in the United States, reported that their Prime platform processed $12 billion in volume on Wednesday alone. This is a single-day record. These are not retail traders buying $500 at a time. These are institutions executing million-dollar block trades. Evidence 3. Options market positioning. The options market is the best predictor of future price because it represents leveraged bets by sophisticated traders. Open interest on $100,000 strike calls for March expiration has increased by 340% since Tuesday. Open interest on $120,000 strikes has increased by 500%. The smart money is positioning for a move well beyond $100,000. Evidence 4, CME futures basis. The CME Bitcoin futures, where institutions trade, are showing a basis of 12% annualized over spot. This means institutions are paying a significant premium to gain Bitcoin exposure through regulated futures. A high basis indicates strong institutional demand that exceeds available supply. Evidence 5, corporate treasury announcements. Since the law was signed, 4 publicly traded companies have announced Bitcoin treasury strategies. A mid-cap tech company announced a $200 million Bitcoin purchase. A regional bank announced they will offer Bitcoin custody to commercial clients. An insurance company announced a $150 million allocation from their general fund. A REIT announced they are evaluating Bitcoin as part of their inflation hedge strategy. These are just the announcements that have been made public. The pipeline of corporate decisions being made behind closed doors is much larger. Evidence. 6. Pension fund movement. The California Public Employees Retirement System, CalPERS, the largest pension fund in the United States with $475 billion in assets, announced they are convening an emergency investment committee meeting next week to discuss digital asset allocation. If CalPERS allocates even 0.5% of their portfolio, that is $2.4 billion in buying. And where CalPERS goes, other pension funds follow. Evidence. 7. Banking announcements. JP Morgan issued a statement within hours of the law being signed indicating they are evaluating opportunities to serve clients in the digital asset space consistent with the new regulatory framework. This is corporate speak for. We're launching Bitcoin services as fast as our lawyers will let us. Bank of America, Goldman Sachs, and Morgan Stanley issued similar statements within 24 hours. 7 independent evidence points, all confirming the same conclusion. The institutional capital that has been waiting for regulatory clarity is now entering the market. The buying pressure that drove Bitcoin to $95,000 was just the first wave. The subsequent waves will be larger. $100,000 is not a ceiling, it's a waypoint. Let me show you the mathematics of why $100,000 is not just possible but probable within the next 30 days. Start with supply. There are 19.5 million Bitcoin in existence. Approximately 3.7 million are considered lost forever, coins that haven't moved in over a decade and are likely inaccessible. Another 6 million are held by long-term holders who have not sold through multiple cycles. Effective liquid supply, approximately 9.8 million Bitcoin. At $95,000, the total value of liquid Bitcoin is approximately $931 billion. Now calculate demand. The spot ETFs now hold 1.1 million Bitcoin. At the current pace of inflows, they will acquire another 150,000 Bitcoin in the next 30 days. MicroStrategy and other corporate treasuries hold approximately 500,000 Bitcoin and are actively buying. Long-term holders are accumulating at their historical average rate of approximately 50,000 Bitcoin per month. Total anticipated demand over the next 30 days, approximately 250,000 Bitcoin. Now add the pension fund catalyst. Even a conservative assumption that 10 pension funds each allocate 0.5% of assets would generate approximately $15 billion in buying. At $95,000 per Bitcoin, that's 158,000 additional Bitcoin demand. Total anticipated demand, including early pension allocation, 408,000 Bitcoin, against liquid supply of 9.8 million Bitcoin. That is 4.2% of liquid supply demanded in a single month. Now calculate the price impact. Bitcoin's price is not set in a vacuum. It responds to marginal buying pressure. Historical analysis shows that for every 1% of liquid supply absorbed by long-term holders or institutions, the price increases by approximately 20%. A 4.2% absorption would suggest an 84% price increase from the starting point of the buying. If the buying began at $85,000, but let's be conservative. Let's assume only half of the projected demand materializes. That's still a 2% absorption rate, suggesting a 42% price increase. $85,000 plus 42% equals $120,700. Even the conservative scenario puts Bitcoin well above $100,000 within 30 days. Now factor in the reflexive dynamics. Bitcoin is a reflexive asset. When the price rises, it generates media attention. Media attention brings new buyers. New buyers push the price higher. Higher prices generate more attention. This reflexive loop accelerates during breakouts of psychological barriers. $100,000 is the most significant psychological barrier in Bitcoin's history. When it breaks, the media coverage will be unprecedented. Every financial news channel will lead with the story. Every newspaper will put it on the front page. Every dinner table conversation will mention Bitcoin. The retail FOMO that follows $100,000 will dwarf anything we've seen before. The math shows that institutional buying alone could push Bitcoin past $100,000. The reflexive dynamics could push it to $150,000 or beyond. This doesn't even account for the supply shock from the halving, which reduced new issuance by 50% last year. Supply is constrained. Demand is exploding. The math only works in one direction. $100,000 is not a question. It's arithmetic. Now let me tell you what Wall Street knows that they don't want you to understand. The same banks that told you Bitcoin was worthless, the same institutions that called it a bubble, a fraud, a Ponzi scheme, they have been positioning for this law for over a year. This legislation didn't appear from nowhere. It was drafted with significant input from financial industry lobbyists. The banking provisions were written specifically to benefit the largest Wall Street firms. They knew it was coming. While their public-facing analysts published reports calling Bitcoin overvalued, their proprietary trading desks were accumulating. While their CEOs appeared on television questioning crypto's viability, their investment banking divisions were building infrastructure. The hypocrisy is staggering but predictable. Wall Street has always operated on the principle of do as I say, not as I do. They tell retail investors to sell while they buy. They spread fear while they accumulate. They call the top while they increase their positions. This time is no different. JP Morgan, the bank whose CEO, Jamie Dimon, famously called Bitcoin a fraud and threatened to fire any employee who traded it, now holds significant Bitcoin exposure through their ETF positions and is preparing to offer custody services to their wealthiest clients. Bank of America, whose analysts published multiple reports predicting Bitcoin's demise, has been building a digital asset trading desk for 3 years. Goldman Sachs, which prohibited its traders from personal crypto investments, now operates one of the largest institutional Bitcoin trading operations in the world. They lied to you. They suppressed your enthusiasm while they built their positions. And now that the law has been signed, they are ready to profit from the rally that they told you would never happen. This is not conspiracy theory. This is documented corporate behavior. The same pattern has played out in every emerging asset class for the past century. The insiders accumulate while discouraging public participation. Then, when the asset breaks out, they sell to the latecomers at much higher prices. The difference this time is that you know the game. You can see the accumulation happening in real time through on-chain data. You can track the ETF inflows. You can read between the lines of the corporate statements. You don't have to be the exit liquidity. You can be alongside the institutions rather than behind them. The law has been signed. The buying is accelerating. The $100,000 breakout is imminent. The only question is whether you position yourself now. While the institutions are still accumulating, Wall Street's playbook is transparent if you know how to read it. Read it and act accordingly. Let me paint the picture of what happens after Bitcoin breaks $100,000, because $100K is not the end of the story. It's the beginning of a new chapter. Phase 1, the media frenzy. The moment Bitcoin crosses $100,000, it becomes the lead story on every major news network. Not the business section, the lead story. Now, Bitcoin hits six figures will be the headline that reaches people who have never thought about cryptocurrency. Your parents, your grandparents, your coworkers who dismissed it as a fad. The psychological impact of six figures cannot be overstated. It transforms Bitcoin from an alternative asset into an established one. It puts Bitcoin in the same mental category as real estate, gold, and the stock market. The retail wave that follows will be massive. Phase 2, the pension flood. The pension funds that have been waiting for proof of concept will see $100,000 as validation. The investment committees that were skeptical will have their doubts answered. It hit $100,000. It's not going away. We need to allocate. This conversation will happen in boardrooms across America over the following weeks. The early adopter pension funds will announce their allocations. The followers will rush to catch up. We could see $50 billion in pension fund buying in the 90 days following the $100,000 break. Phase 3, the corporate treasury acceleration. When MicroStrategy announced their Bitcoin strategy at $10,000, they were considered crazy. Now they're sitting on a $15 billion unrealized profit. Every CFO in America is looking at that success and reconsidering their treasury strategy. At $100,000, the risk of not having Bitcoin exposure becomes greater than the risk of having it. We will see a wave of corporate treasury announcements that makes the current trickle look like nothing. Phase 4, the supply crisis. Here's what nobody is talking about. There are only 21 million Bitcoin that will ever exist. The institutions are now competing for a fixed supply. The more they buy, the less is available. The less is available, the higher the price must go to find sellers. At some point, likely between $100,000 and $150,000, the institutions will realize that they cannot acquire the size they want at any price. The sellers will simply dry up. This is when the price goes vertical. Not 10% moves, not 20% moves, 50% moves in a week. The kind of moves that seem impossible until you remember that the supply is fixed and the demand is unlimited. Phase 5, the new monetary reality. At $200,000 or $300,000 Bitcoin, the total market cap exceeds gold. At that point, Bitcoin can no longer be dismissed as an alternative asset. It becomes a primary monetary asset. Central banks that have been watching from the sidelines will be forced to consider allocation. Sovereign wealth funds will add Bitcoin to their reserves. The monetary system itself will begin to restructure around digital scarcity. $100,000 is the door. What's on the other side is a complete transformation of the global monetary system. And the door is about to open. If you have been holding Bitcoin through the crashes, the regulatory attacks, the endless feuding from mainstream media, this is your moment. You held at $69,000 when it crashed to $16,000. You held when FTX collapsed and everyone said crypto was dead. You held when the SEC sued every exchange in America. You held when your friends mocked you and your family questioned your judgment. And now the law has changed in your favor. The same government that attacked Bitcoin for a decade just signed legislation protecting it. The same banks that called it worthless are now racing to offer services. The same institutions that laughed at crypto are now begging for allocation. You were right, the volatility was worth it. The doubt was worth enduring. The patience was worth exercising. The law that was signed this week is your vindication. It proves that the thesis you held onto through years of uncertainty was correct. Bitcoin is not a fad. It is not a bubble. It is a technological and monetary revolution that is now being recognized by the most powerful government on earth. $95,000 is not the reward for your patience. It's the acknowledgement that your patience was justified. $100,000 is coming. $150,000 is coming. Higher still is coming. And you will be there because you held when others sold. You accumulated when others fled. You understood what others couldn't see. This is your moment. The holders who stayed the course through the darkest days are about to see their conviction rewarded beyond their most optimistic projections. The law has been signed. The institutions are coming, and you are already positioned. Let me give you a specific action plan for the next 30 days as the $100,000 breakout unfolds. Week 1, solidify your position if you are underweight. Bitcoin relative to your target allocation, do not wait for a dip. The institutional buying is providing a floor that makes significant dips unlikely. Every day you wait is likely a day you pay a higher price. If you have Bitcoin on exchanges, consider moving a portion to self-custody. The exchange system has proven fragile. Your keys, your coins. Review your security practices. As your Bitcoin becomes more valuable, it becomes a bigger target. Hardware wallets, strong passwords, seed phrase security. Take this seriously. Week 2, monitor the breakout. $100,000 will be volatile. The algos will fight it. There will be profit taking from traders who set 100K as their exit. The price may break through and pull back multiple times before establishing above. Do not panic if the first break fails. Resistance levels often require multiple tests. What matters is the trend, and the trend is clearly upward. Watch the ETF flows as your signal. As long as ETFs are seeing net inflows, the institutional bid is in place. A shift to outflows would be a warning sign. So far, there is no sign of institutional selling. Week 3, watch for pension announcements. This is when the pension fund announcements will begin. CalPERS, New York State Common, Texas Teachers. The largest funds will move first. Each announcement will be a catalyst. Each catalyst will bring Bitcoin to new audiences. The compounding effect of multiple announcements will accelerate the rally. Position yourself before the announcements, not after. Week 4, plan for the new reality. By the end of 30 days, Bitcoin will likely be trading well above $100,000. The paper gains will be significant. The temptation to sell will be strong. Resist it. The structural changes from this law will take months to fully express in the price. The pension fund buying will continue for quarters, not weeks. The supply shock is permanent. If you believe Bitcoin is going to $200,000 or $300,000, selling at $110,000 makes no sense. You would be trading a generational asset for a temporary gain. And the appropriate strategy is to hold through the volatility, potentially taking small amounts of profit to cover life expenses, but maintaining core exposure for the full cycle. This is not a trade. This is a position in the future of money. Treat it accordingly. Throughout the 30 days, stay informed. Subscribe to this channel. Follow the on-chain data. Ignore the mainstream media's attempts to call the top. The game has changed. The law has changed. The institutions have changed. The only thing that shouldn't change is your conviction. Let me address the bear case, because no analysis is complete without acknowledging the risks. Risk 1. Implementation delay. While the law is signed, the regulatory agencies have 180 days to implement the detailed rules. There could be delays, complications, or interpretations that slow institutional adoption. This risk is real, but unlikely to prevent the rally. The law provides enough clarity for institutions to begin moving. The detailed rules will affect the pace, not the direction. Risk 2. Macro shock. A global financial crisis, a major war, or a pandemic could create a risk-off environment where all assets, including Bitcoin, sell off. Bitcoin has historically recovered quickly from macro shocks, often faster than traditional assets, but the short-term volatility could be severe. Risk 3. Technical failure. A major bug in the Bitcoin protocol, a successful attack on the network, or a fundamental technical failure could undermine confidence. This risk has existed since Bitcoin's creation and has never materialized. The network has operated flawlessly for 15 years, but the risk is non-zero. Risk 4. Political reversal. A future Congress could pass legislation reversing the Digital Asset Market Structure Act. A hostile administration could appoint regulators who interpret the law narrowly. This risk exists, but is limited by the bipartisan nature of the current legislation. Both parties voted for this law. Reversing it would require significant political capital that is unlikely to be spent on crypto regulation. Risk 5. Concentration risk. If too much Bitcoin ends up in the hands of a few institutions, it could create systemic risk or enable market manipulation. This is a long-term concern that is worth monitoring, but unlikely to affect prices in the near term. None of these risks are sufficient to change the fundamental thesis. The law has been signed, institutional barriers have been removed, the buying is accelerating, risks exist in every investment. What matters is whether the potential reward justifies the risk. In the case of Bitcoin, with regulatory clarity finally achieved and institutional adoption accelerating, the risk-reward has never been more favorable. Acknowledge the risks, position accordingly, but don't let fear of what could go wrong prevent you from participating in what is going right. Let me leave you with this. For 15 years, Bitcoin has survived every attack. Government bans, exchange collapses, regulatory warfare, media campaigns declaring it dead hundreds of times. It survived because the fundamental value proposition is real. Digital scarcity, decentralization, permissionless value transfer. These properties cannot be legislated away, and they cannot be replicated. And now, for the first time in its history, the most powerful government on Earth has stopped fighting Bitcoin and started embracing it. The law signed this week is not just a policy change. It is a surrender, an acknowledgement that Bitcoin has won the war of legitimacy. The $95,000 price you see today is the market beginning to price in this new reality. But the pricing process has only begun. Pension funds are meeting. Corporate treasuries are deliberating. Banks are building. The largest wave of institutional capital in crypto history is forming. $100,000 is not a ceiling. It is a floor being established by institutional buying that will continue for months. $150,000 is not a fantasy. It is a mathematical probability given the supply constraints and demand explosion. $200,000 and beyond is not a dream. It is the logical endpoint of institutional adoption of a fixed supply asset. The only question is whether you are positioned for what's coming. The law has been signed. The institutions are moving. The 100K breakout is imminent. This is Chronicles of Currency. The future of money is being written right now. Make sure you're on the right side of history. I'll see you on the other side. If this analysis was valuable, subscribe and hit the notification bell. I'll be providing updates throughout the $100,000 breakout and beyond. Drop a comment. What's your Bitcoin price target for this cycle? Are you adding to your position? Share this video with someone who still doesn't understand why this law changes everything. The biggest monetary shift in a generation is happening right now. Don't watch from the sidelines. Chronicles of Currency, out.